All right, let's talk about something that can make just about anyone's head spin: taxes on your investments. If you've ever felt like you need a secret decoder ring just to figure it all out, believe me, you are in good company. Today, we're going to draw a map to get through that maze.
So let me ask you a couple of questions. Did you sell some stock last year? Maybe lock in a nice little profit? Or how about this? Have you ever used crypto to buy something? I mean, anything from a cup of coffee to a brand new car?
If you nodded your head to either of those, well, surprise, you probably created what the IRS calls a taxable event. It's these everyday financial moves that have tax consequences we don't always see coming. And that's exactly what we're going to unpack today. Okay, so before we can dive into the really tricky stuff with investments, we have to start with the foundation, the basic rules of the game for how all your income is taxed. Trust me, once you get this, everything else starts to click into place. First up is this crucial concept called bracket creep. Just imagine you get a pay raise because of inflation, but you can't actually buy any more stuff with it. Your real purchasing power hasn't changed. Well, it wouldn't be fair for that phantom raise to bump you into a higher tax bracket, right? So to prevent that, the IRS adjusts these brackets for inflation every single year. And here are those inflation-adjusted brackets for 2025. Now, the key thing to understand about this chart is that our tax system is progressive. That just means you don't pay one flat rate on all your money. Think of it like climbing a ladder. As your income goes up, only the money within each new rung gets taxed at that higher rate. So everyone, no matter how much they make, pays 10% on their first chunk of earnings, then 12% on the next, and so on. It's a huge misconception that your entire income gets taxed at your highest bracket rate. So that's the playbook for your paycheck. But what about the money that your money makes? Well, that's a whole different ballgame. It's got its own rulebook, and frankly, it's a set of rules designed to either reward you or penalize you. This brings us to capital gains. That's just the profit you make when you sell an asset. And when it comes to taxes on these gains, there is one magic number you need to remember: 1 year. Hold an investment for a year or less, and any profit you make gets taxed at your regular, higher income rate. But hold it for just 1 day longer, and poof, it becomes a long-term gain. And you get access to much lower tax rates. The takeaway here is super simple. Patience can literally save you thousands of dollars. And then there's crypto. This is where so many people get tripped up. So you have to burn this one single rule into your brain. The IRS sees crypto as property, just like a stock or a house or a piece of art. It is not treated like currency, like a dollar bill. Understanding that one single distinction is the key to everything else. Let's make that totally real. Say you use your crypto to buy a $45,000 car. Pretty cool. But let's say you only paid $40,000 for that crypto in the first place. Well, you just realized a $5,000 capital gain. In the eyes of the IRS, you didn't just buy a car, you effectively sold your property, the crypto, and then used the proceeds. So every single time you spend crypto, you are also selling it, creating a potential taxable event. Okay, so knowing the rules is one thing, but playing the game to win, that's a whole other level. So let's open up the investor's playbook and look at some of the strategies you can use to make these rules work for you. Let's be real. Nobody likes seeing red in their portfolio. It stings when an investment goes down. But what if I told you that a loss could actually have a silver lining when it comes to your taxes? This brings us to a really powerful strategy called tax loss harvesting. This is where you strategically sell an investment that's doing poorly to intentionally lock in that loss. Now, why on earth would you ever want to lock in a loss? Simple. To use that loss to cancel out the taxable gains you have on your winning investments. Here's the 4-step process. 1, you sell that losing investment to realize the loss on paper. 2, you use that loss to offset or cancel out any capital gains you might have. Now, if your losses are actually bigger than your gains, you get another benefit. You can deduct up to $3,000 of that excess loss from your regular income. And finally, if there's still any loss left over, you just carry it forward to use in future tax years. It's a fantastic way to turn a portfolio lemon into some tax lemonade. But you have to know the rules. The biggest one is the wash sale rule. You can't just sell a stock to get the loss for tax purposes and then buy it right back the next day. The IRS says no, no, no. You have to wait 30 days before you buy back that same or substantially identical security. But guess what? Here's that crypto twist again. Since it's property and not a security, it's generally exempt from the wash sale rule, and that is a huge strategic advantage. It gives you way more flexibility.
Here's another pro strategy. It's called asset location. It's not about what you own, but where you own it. The basic idea is to hold investments that generate a lot of taxable events, like funds you're actively trading, inside a tax-deferred account, like a traditional IRA. That way, all that buying and selling can happen inside a little tax-free bubble without you getting a bill every single year. And finally, let's talk about the end game. What happens to the taxes on assets when they get passed from one generation to the next? This is where one of the most powerful and, let's be honest, most debated rules in the entire tax code comes into play. It's called the step-up in basis. In simple terms, when you inherit an asset like a stock or a house, its original purchase price, what we call its cost basis, is just wiped away. For you, the heir, the new cost basis becomes whatever that asset was worth on the day the original owner passed away. The old price is basically forgotten. And to see just how staggering the impact of this is, look at this example. Imagine your grandmother bought a stock for $2, and it's worth $15 when you inherit it. Without the step-up, if you sold it, you'd owe capital gains tax on a $13 profit. But with the step-up, your new basis is $15. If you sell it for $15, your taxable gain is zero. Absolutely nothing. Decades of growth, and the tax bill for it just vanishes into thin air. Now, this obviously leads to a really big question. Is this a fair provision, or is it a massive tax loophole? Critics will argue it overwhelmingly benefits the wealthy, allowing them to pass on fortunes tax-free, while supporters say getting rid of it could lead to unfair double taxation. And just to put the scale of this debate into perspective, this isn't just pocket change. The Peter G. Peterson Foundation estimates that in 2025 alone, the single provision will result in about $61 billion in foregone federal tax revenue. It's a personal tax strategy that has enormous implications for the national budget. So let's wrap this all up with the crucial takeaways. First, think long-term. Holding your investments for over a year is your best friend. Second, harvest your losses. Turn those portfolio losers into a winner for your tax bill. Third, always know your cost basis, especially for anything you inherit. And finally, one more time for the people in the back, remember that in the world of taxes, every single crypto transaction counts. And that really brings us to our final thought. The tax code is not permanent. It's a living document. It's constantly being debated and changed. Every rule we just talked about is on the table. So the question I want to leave you with is this. If you could rewrite the rules, what's the one thing you would change?